In this video I'm going to show you two of the best investment opportunities that are hiding in plain sight. These aren't risky bets, they're dominant businesses with massive moats. One controls the future of television, the other is a retail titan with unbeatable customer loyalty. Before I reveal my top two stocks to buy for long-term compounding, hit the like button, share your thoughts, and subscribe for more investing insights. Let's dive into the first company, Roku, ticker symbol ROKU. If you've ever streamed your favorite show or movie on a smart TV, there's a good chance you've interacted with Roku's technology, even if you didn't realize it. Roku has quietly become a household name, but there's much more to this company than meets the eye. Most people see Roku as just a streaming device, a little purple box or stick you plug into your TV. But that's missing the point entirely. Roku's real power lies in its ability to connect people to the world of streaming content, acting as the bridge between viewers and the endless entertainment options available today. Roku is fundamentally a platform company, not just a hardware maker. They built the leading operating system for smart TVs, and in doing so, they become the gateway for streaming content in millions of homes. Their software is the backbone that powers the streaming experience for countless users. Think of Roku like Windows for PCs or Android for smartphones. Roku is the operating system for television. Their genius move was to license the Roku OS to TV manufacturers like TCL and Hisense, allowing these brands to offer smart TVs with Roku's intuitive interface built right in. Now millions of TVs are sold with Roku built in, no extra device required. This capital-light model means that every new TV sold with Roku's OS is a new user added to their ecosystem, without Roku having to manufacture the hardware themselves. It's a brilliant way to scale rapidly and efficiently. Today, Roku OS is the #1 smart TV platform in the US, Canada, and Mexico by hours streamed. Once you're in the Roku ecosystem, switching to another platform is a hassle. Your apps, preferences, and viewing habits are all tied to Roku. This creates a sticky user base that's unlikely to leave. This stickiness gives Roku a powerful moat. But here's the key. The real money isn't in selling hardware. It's in the platform segment, which is driven by advertising and digital services. Roku's business model is all about monetizing its massive user base. Roku monetizes users in several ways. Through ads on the home screen, on the Roku channel, and by taking a cut of subscriptions and video purchases made through its platform. Every time you see an ad or subscribe to a service via Roku, the company gets a piece of the action. As advertising dollars shift from traditional TV to streaming, Roku is perfectly positioned to benefit. Advertisers are desperate to reach cord cutters, people who have ditched cable for streaming, and Roku offers both the audience and the data to make those ad campaigns effective. This transition is still in its early innings, and Roku is at the center of it. Unlike Apple or Google, Roku is platform neutral. They don't care what you watch, as long as you're watching it on their OS. This neutrality makes them a valuable partner to content companies, rather than a direct competitor. Content providers want access to Roku's massive user base, and Roku is happy to oblige. The Roku channel, their free ad-supported streaming service, keeps users engaged and generates valuable first-party data. Financially, the hardware side of the business actually runs at a loss by design. It's a user acquisition tool, not a profit center. The real profits come from the platform. The platform segment, with its high margins, is the true growth engine for Roku. Average revenue per user, or ARPU, keeps climbing year after year, proving that their monetization strategy is working. As more users join and spend more time on Roku, the company's revenue potential only increases. The connected TV ad market is just getting started, and Roku is the toll booth collecting fees as traffic flows through. Yes, the stock can be volatile. Supply chain issues, economic slowdowns, and fluctuations in ad spending have all impacted the share price. But these are bumps in the road, not roadblocks. These are short-term headwinds. The long-term shift to streaming is unstoppable. Roku is the leading platform enabling that shift, and as more households cut the cord, Roku's addressable market only grows. Investing in Roku is essentially a bet on the future of TV advertising and the continued rise of streaming. The network effect is real. More users attract more content and advertisers, which in turn attracts even more users. This virtuous cycle strengthens Roku's position over time. It's a long-term play, not a quick trade, and the potential for compounding returns is significant. Focus on the fundamentals: growing users, rising engagement, and a high-margin platform business. Founder and CEO Anthony Wood has a proven track record of out-executing much bigger rivals. His vision and leadership have been instrumental in Roku's rise to dominance. Roku has already beaten Apple, Google, and Amazon in the streaming device market, and now it's winning in the platform space. Of course, there are risks. A new competitor could emerge, or ad growth could slow if the economy takes a hit, but Roku's scale and entrenched position make it tough to dislodge. Their scale and position cushion the downside, while the upside is huge if they keep executing. The market often obsesses over hardware sales or quarterly ad numbers, missing the big picture. Roku owns the digital real estate of streaming. Every time someone turns on a Roku-powered TV, they're stepping onto Roku's turf. That's why Roku is my first pick. It's a high-growth company with a durable moat, trading at a valuation that underestimates its long-term potential. The market may be focused on short-term noise, but the fundamentals are strong and the opportunity is massive. Roku currently carries a market capitalization of $14.89 billion, but its financial picture shows ongoing pressure. The company posted an earnings per share loss of -0.19, with total revenue reaching $4.11 billion in 2024. Despite that top-line growth, profitability remains elusive, as Roku reported a net loss of $129.38 million, highlighting the continued challenges of scaling its platform while managing costs in a competitive streaming landscape. For patient investors, the compounding opportunity here is undeniable. Roku is building the infrastructure for the next generation of media consumption, laying the digital pipes that will carry entertainment into millions of homes for years to come. If you want to learn how to find undervalued stocks like Roku, check out my Value Stocks Investing Master Course, link in the description. I'll teach you how to spot companies with hidden potential and durable competitive advantages. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community. Details below. Don't miss out on the next big investing opportunity, subscribe and stay informed. Our community is all about sharing insights and helping each other grow as investors. Roku isn't just a device, it's the backbone of streaming's future. The company's platform approach, sticky ecosystem, and ad-driven model set it apart from the competition. As the streaming landscape evolves, Roku's role as the central hub only becomes more important. As streaming grows, Roku's role only gets stronger. The market may be missing the forest for the trees, but you don't have to. Roku is uniquely positioned to capture the value created by the streaming revolution, and that's why it's at the top of my buy list. Let's move on to my second pick. A very different kind of business, but just as compelling. Ready? Let's talk about Costco. Transition to next scene. For my second pick, we're shifting gears from the world of high-tech innovation to a company built on high predictability and everyday value. Costco, ticker symbol COST. Costco isn't just another retailer, it's a membership powerhouse, a business that's quietly redefined what it means to shop in bulk and save. The real engine behind Costco's success? It's not just the pallets of paper towels or the giant tubs of peanut butter, it's the annual memberships, those little plastic cards that unlock a world of savings and exclusivity. The low prices and those famously oversized packages are just the bait to get you in the door. Once you're a member, you're part of an exclusive club, and that's where the magic happens. Most retailers depend on hefty product markups to drive profits. But Costco does things differently. They cap their markups at around 14 to 15%, which is dramatically lower than what you'll find at most competitors. Instead, about 70 to 75% of Costco's operating income comes from those annual membership fees. That's a recurring, high-margin revenue stream that's largely insulated from the ups and downs of retail sales. This model creates a steady, predictable cash flow that most retailers can only dream of. It's like a subscription business, but with massive physical warehouses instead of streaming content. Think of it as a subscription service for groceries, household goods, and even electronics, except you get to walk the aisles and hunt for deals in person. The result? Costco enjoys some of the highest customer loyalty in the world. Global membership renewal rates are over 90%, and, in the US and Canada, they're even higher, often reaching 92 or 93%. That's a loyalty loop that's nearly impossible for competitors to break. Once people join, they rarely leave. Walmart or Target can't just slash prices to compete with Costco. They'd destroy their own margins and business models in the process. Costco's model is almost impossible to copy. Another key to their success? A limited selection of products. While a typical supermarket might carry over 40,000 items, Costco stocks fewer than 4,000. This hyper-focused approach is a game-changer. By concentrating their buying power on a smaller number of items, Costco can purchase in massive quantities, negotiate the best possible prices, and pass those savings directly to their members. This strategy also means faster inventory turnover, less waste, and lower operating costs. It's a win-win for both the company and its customers. The constantly rotating selection creates a treasure hunt atmosphere. If you see something you like, you'd better grab it, because it might not be there next time. This sense of urgency drives repeat visits and encourages shoppers to fill their carts to the brim, boosting average transaction sizes. And then there's Kirkland's Signature, Costco's private label brand. It's become a household name, trusted for both quality and value, and it generates more revenue than many major national brands. In fact, many Kirkland products are made by the same manufacturers as the big-name brands, but they're sold at a lower price, giving members even more reason to stay loyal. The Kirkland brand also gives Costco extra leverage when negotiating with suppliers, ensuring they always get the best deals for their members. And Costco's growth story is far from over. International expansion is just getting started, with new warehouses opening in markets like China, where demand has been overwhelming. Each new warehouse is typically profitable almost from day one, quickly attracting a loyal base of new members who are eager to join the Costco club. Membership fees also have room to rise. Historically, Costco increases its fees every 5 to 6 years, and each increase is met with little resistance. Even a small bump in the annual fee, when multiplied by over 120 million members, translates into a massive profit boost for the company. Customers rarely flinch at these increases because the value they receive is so obvious, most feel they're getting more than their money's worth. The company boasts a market capitalization of $426.54 billion and trades at a price-to-earnings ratio of 51.57. Earnings per share came in at 18.63, supported by massive revenue of $254.45 billion in 2024. Most importantly, Costco delivered strong bottom-line performance, generating net income of $7.36 billion, reinforcing its reputation as a consistently profitable, cash-generating business with durable consumer demand. Investing in Costco is a bet on operational excellence, customer loyalty, and a business model that's built to last for generations. Costco is also known for treating its employees well, paying above-average wages and offering solid benefits. This keeps turnover low and service levels high, which in turn keeps customers happy. Every efficiency gain, every cost saving, is passed back to members as lower prices, reinforcing the loyalty loop and making the value proposition even stronger. Of course, there are risks. The main one? Valuation. Costco often trades at a premium compared to other retailers, but that's the price you pay for quality, consistency, and predictability. Another risk is the rise of e-commerce, but Costco's unique warehouse experience, unbeatable value, and the thrill of in-person shopping are tough to replicate online. Even Amazon, the king of online retail, hasn't managed to crack the Costco code or lure away its most loyal members. Costco is slowly building out its own e-commerce capabilities, but the heart of the business remains the physical warehouse and the in-person experience. When you invest in Costco, you're buying a piece of one of the world's most durable, time-tested businesses, one that's proven it can thrive in almost any economic environment. You won't get explosive, overnight growth, but you will get steady, relentless compounding, year after year, decade after decade. It's the kind of stock you can buy, tuck away, and hold for decades, letting the power of compounding do the heavy lifting. Costco is the anchor of a well-built portfolio, a bedrock of stability and reliability that can weather almost any storm. Their membership model, massive scale, and unmatched customer loyalty create a fortress-like moat that's nearly impossible for rivals to breach. That's why Costco is my second pick for long-term investors who want both peace of mind and steady returns. If you're looking for a stock you can count on through thick and thin, in good times and bad, Costco is it. The combination of recurring revenue, operational excellence, and customer loyalty is a rare and powerful formula for long-term wealth building. While others chase the next hot trend or speculative stock, Costco quietly compounds wealth year after year for patient investors. It may not be the flashiest name in your portfolio, but it's one of the most powerful and dependable. For those who value peace of mind, steady returns, and a business model built to last, Costco is a clear choice. That's why it deserves a prominent spot in any long-term portfolio, serving as a foundation for your financial future. Ready to build wealth the boring, reliable way? Costco is your ticket to compounding success. Let's wrap up with some final thoughts on these two picks. Transition to next scene. There you have it. Two very different, but equally compelling long-term investments that each bring something unique to the table. Whether you're drawn to the fast-paced world of technology or the steady reliability of retail, both Roku and Costco offer intriguing opportunities for investors looking to grow their wealth over time. Roku is a high-growth innovator at the heart of streaming's future, constantly evolving and adapting to new trends in digital entertainment. Costco, on the other hand, is a fortress of stability, built on customer loyalty, operational excellence, and a proven business model that has stood the test of time. Both companies reward patient investors in different ways. Roku with its potential for rapid growth, and Costco with its consistent performance and resilience. So, which do you think has the stronger long-term edge, Roku's innovative streaming platform or Costco's powerful membership model that keeps customers coming back? I'd love to hear your thoughts and opinions, so let me know in the comments below, and if you enjoyed this video, don't forget to like, share and subscribe for more investing ideas and insights. Thanks for watching, see you in the next one, and happy investing.